Good morning, everyone, and welcome to the Digital Energy Festival. The session this morning is an Oil and Gas Council hosted digital dialogue on investment, and we will be looking at what next for African oil and gas. This session is not live, and as such, there will be no opportunity for Q&A. However, I encourage you to make use of the networking options in Swapcard, and I hope you enjoy the panel. I will now hand over to our moderator, Tabriz Khan, EMEA Director for Oil and Gas Transactions at Ernst & Young. Thank you, Tabriz.
Thank you, Sam. Good morning, good afternoon, good evening, wherever you are, and welcome to another one of Oil and Gas Council's webinars. As Sam was saying, the topic for today is investment focus. What next for African oil and gas? I'm joined by a very diverse panel. Before we move on to introduce them briefly, my name is Tabriz Khan. I lead EY's Africa Oil and Gas Corporate Finance Practice. We're joined today by Mark Allen, who's a subsurface director at Asala Energy. He's a seasoned subsurface professional with over 20 years of international E&P experience. We're also joined by Chinedu Mofunanya, who's a portfolio manager at the Nigerian Sovereign Investment Authority. Chinedu leads teams focused on multi-asset investing across developed and emerging markets. We're joined by Mohammed Rali Badisi. He's a senior attorney for energy and finance at the Office of the General Counsel at the US Department of Commerce. Mohammed advises governments in emerging markets on commercial law reforms which are addressed at increasing production and increasing access to power. We're also joined by Jérôme Halbou. Jérôme is a founding partner of 4D Global Energy Advisors. He's a seasoned veteran of the oil and gas industry with almost 3 decades of experience. And he's a banker, he's an advisor. He's also currently serving on a couple of energy companies. We're also joined by Mohammed Stevens, who's a legal consultant at the African Legal Support Facility hosted by the African Development Bank. I totted it up. Overall, on this panel, we have over 100 years of sector and industry experience. With that, let me set some context for our discussion. Since the start of the year, the oil price has fallen by 37% as it stands today. Production across the globe on a daily basis has gone from 99 million barrels to 86 million barrels in Q3 2020. Surplus inventories today could supply the world's energy demands for weeks, if not months. And global E&P capex spends have been cut by hundreds of billions, I should say. And that outlook is not changing in the foreseeable future. Energy transition, which was a topic of the past, has grown active legs at the leading oil and gas companies, as well as within the worlds of the financing world. So what does this all mean for African oil and gas? As we know, African oil and gas is an inbound investment sector. You could broadly classify African oil and gas into 4 regions: production and development at North and West Africa, development in East Africa, and exploration in Central and Southern Africa. Our clients have responded in different ways to what's happened in this year. There have been no new capital commitments into African oil and gas, with the exception of some operator spends and some selected lender spending for some assets. And I choose the word some purposefully because the universe of financing opportunities, whilst it may be small, success has been relatively low. The majors continue to sell their assets in African geographies, potentially with the exception of one major. And that is creating some significant opportunities for the mid-cap market of upstream operators who previously never had access to fantastic assets like these, which are game-changing for these companies. However, valuation and financing are still big hurdles for these companies to successfully acquire their assets. Governments are actively working and taking steps, some small and some big, in order to preserve their cash flows and continue to attract investors. Some even argue that there is a real possibility that certain governments or certain countries in Africa may not see the reserves in the ground being monetized. From a financing perspective, the public equity markets are closed for African oil and gas as we have seen. However, private equity is available for selected opportunities. Lenders have been very supportive of their incumbent clients, and we have seen that the commodity trading houses are continuing to finance producers in return for their barrels. What does this all mean? And we're going to be discussing this on the panel. So enough from me, and let's turn to our first panelist. And Mark, I'm going to transfer over to you to share your views, please.
Okay, thanks, Tabriz. Good afternoon or good morning, everyone, wherever you are. I'd like to cover a few of the questions that were put forward to the panel in some of the pre-readings, so I'll just break that down into several steps. The first thing we want to talk about is what shifts we'll see in small capital markets if financing can't be secured. Well, first off, in 2020, profits have definitely been harder to come by, more challenged to generate in the current oil price environment than certainly in 2019. The oil and gas industry as a whole is today, I think, struggling to be represented as a competitive investment. So what's the result if there's less capital available? Well, I want to start with the people first. High-value professionals, like many of you are there in the industry, are starting to exit the industry through redundancies, through premature retirements, and through career pivots. And this loss of high-quality staff is effectively irreversible, and its impact can be felt in the short term in the form of reduced operational rigor and technical creativity. So I think the personal side is something we must always remember. From a business perspective, well, without financing, ultimately developments don't proceed, wells don't get drilled, and without that, production output will decline, typically at 5 to 10% per annum, until they do. Certainly, my company works in West Africa, and the majority of West African oil and gas assets are mature. Many of the basins came on stream in the 1950s and 1960s, and it gets increasingly difficult to locate new targets to drill or new wells to work over. Therefore, low oil prices and the drive towards debt repayment or investor yield for some of the private equity funds will lead to a steady decline in reinvestment, and the industry's contribution to their host nations, financial contributions and employment contributions, I think will continue to decline. From the cash flow management perspective, if the banks are reluctant to issue new capital and funds also, it can be difficult. Now let's look at the typical reserves-based lending facility that's utilized by many small cap companies. If these expire or time out, they'll eventually trigger steep amortization schedules, and that in the process will potentially erode the liquidity of the portfolio companies that had relied on the debt to manage their day-to-day cash flow. In the worst case scenario, a lack of liquidity could even result in the premature demise of small caps through buyout or bankruptcy. So in summary, debt finance, if it's no longer available for operators to refresh their portfolios or pursue new exploration or acquisition opportunities, that engine for developing and maintaining growth in this niche market can be very challenging. From the equity capital side, I think it's well documented that the super majors are now seeking to divest some of their assets, some of their legacy positions in Africa over the next couple of years, either due to energy transition goals or the relatively high cost of doing business in Africa. Today, the European equity finance for small caps is most likely to be sourced, as Teresa said, from private equity funds, traders, or maybe from straight cash flow. And for the energy-focused private equity funds, in turn, raising new capital, I think, is also becoming difficult for several reasons. They've seen bankruptcies rise in the United States, so resulting in some of the LPs losing faith in the traditional high-performing segment. And also, it's just been hard to raise new funds, new sources of capital this last year or two. COVID-19 hasn't helped. Access to private equity capital is getting more difficult, presumably due to more increasing uncertainty over the long-term oil price volatility. And finally, the ESG screening criteria are becoming ever more rigorous, with these criteria such as carbon intensity, where Africa unfortunately doesn't score very highly compared to other parts of the world, can be increasingly scrutinized. So in terms of debt access, banks are expanding their clean energy, they're expanding their clean energy financing at the expense of the oil and gas sector, which means they might use some of their traditional energy funds to source, to support new industries like solar and wind energy. And this means that there's a diminishing pool of debt capital available to the operators. And they'll increasingly look to the best management teams with the best assets, with the best growth potential, and the most financially robust business to be supported. Additionally, I think that banks are starting to high grade their clients by looking for other sources of revenue, such as M&A advisory fees or management fees and the likes, meaning they're going to be more selective about which investments they will back. So a word of warning finally, over leverage during these high oil price periods has hit many companies hard. In some cases, prioritization of debt repayment has really curtailed exploration programs or left many potentially attractive prospects undrilled. The interest in licensing rounds is declined, and it just makes the opportunities for the host countries look a bit more negative on the outlook. Smaller companies are going to react. I think they're going to prize agility over big companies and be able to react quickly. It's important that they're not over leveraged and that they remain flexible, requiring the continued support of a strong management team so I'll start again. Organizationally, it's important that small E&Ps are going to retain their autonomy and flexibility, which requires a strong management team with a unified and clear vision, and with the right assets, and they should get the right investor support.
Mark, thank you for sharing those really valuable thoughts with us. Quite a lot of interesting points, and we'll come on to them in the Q&A. So now we're going to move on, and I'm going to invite Chinedu. Please go ahead and talk us through what you're seeing and what you're wanting to invest in, and what your thoughts are.
Thank you, Tabriz, and good morning or good afternoon, everyone, depending on where you are. So I think it's important to situate the conversation on the context of what has happened this year in across the world and how that affects Africa. Like every other region, there was a shutdown of the global economy and therefore the African economy through due to COVID. And thankfully, we didn't have as much cases on the continent. Somewhat the cases on the continent seems to have been managed. However, on the economic side, Africa has suffered from the impact of the epidemic on its trading partners, the disruption to global supply chains, and also, like Tabriz said, the collapse of commodity prices, down 37% on a year-to-date basis. We've seen outflows, right? Investment outflows from the continent, and clearly the lack of investor confidence going forward into 2020, going into 21. The World Bank, as you believes that the continent will contrast by 2.8% and hopefully rebound in 2021. So this kind of leads us to a situation where you have low growth and everyone is coming from a certainly low base. You have rising inflation, currency depreciation of the local currencies, and an economic structure that focuses on one service or one product, be it oil and gas for Nigeria and Angola, or countries like Cape Verde, who depend largely on tourism. Everything seems to have shut down, and that kind of leads us to what next, right? What do we have to do, and where are the investment opportunities going forward? I believe that there has to be some homegrown solutions to the issues that affect the continent, especially on the economy. There certainly wouldn't be any proper investment returns without the context of growth, economic growth on the continent. And I believe where we can focus on is on the midstream, right? Energy consumption, gas specifically. Africa, as it is, has 7.5% of gas reserves, but clearly it's just about 3.8% of total consumption. Certainly there is a lot of runway in that regard. And the midstream sector, investment in the midstream sector, will definitely provide the source of investment, one, and certainly help the growth of the economies. So I guess what has happened over the last 5 to 6 years is that we've seen a lot of growth in that region. We've seen a lot of investments coming into that space. And this tied into the import substitution focus of most African countries, especially Nigeria. So the extent that we have these gas reserves, I think they should be exploited and utilized. We've seen a drop in LNG costs. We've also seen a drop in the break-even ranges. So this has kind of built a stronger investment case for the midstream. Essentially, what I'm trying to say is, if we're able to have clusters, right? Clusters of industries, clusters of manufacturing that have the ability to pay, and we aggregate them and provide the needed infrastructure, gas infrastructure, to effectively service those investments or service those clusters. This will certainly provide a decent, a positive investment outcome. So we invest in multi-assets across the continent and globally. And we've seen increasingly a trend of, as alluded by Tiberius, private equity funding coming into gas, into the gas space, certainly in the oil space, but certainly into gas space, whether it comes from LPG processing or liquefied natural gas, or just gas infrastructure as it is. And this, in the minds of an investor, is a defensive sector. It also provides its dollar return, so that certainly is not impacted by currency valuations or currency fluctuations, I would say. And it provides a decent investment outcome. So broadly speaking, right, the midstream sector, which historically hasn't had most of the investments, is being positioned to attract better investment. The cost structures remain attractive, and this provides the right investment outcomes. One, it also helps economic growth for the industry, for the continent and for countries in particular, and on a more sustainable basis, it's better for the environment. Thank you.
Thank you, Chinedu. Some really nice points there. I really like the homegrown solutions point, which we will come on to in the Q&A, and some good points around gas. Thank you. Mohammed Badisi, I'm going to come on to you next and tell us what you're doing. This is a great opportunity for you to advise governments and help them think through how to increase their energy production and access to power. So leave you to share your views, please.
Well, no, thank you, Tabriz. And I'll tell you, it's easy to have this discussion with this panel because they've already raised the most important points already. So I appreciate, the work of my colleagues. I think I'll build a little bit in making a few points. So the place where I sit is we work directly with governments in sub-Saharan Africa, but also around the world, on the public policy aspect of oil and gas development. That is to say, how is it that regulations are both a source of guidance, but also a market activity? In a way, regulations more than ever have become a cost concern in many of these markets. They've become a consideration of the viability and the bankability of some of these projects. So I think in the cost environment that everybody has described, considering the volatility, considering the demand uncertainty, the advice that we've been giving governments and the conversation that we've been having most often is, do you reimagine the approach to the definition of value in the oil and gas sector? Which is to say, traditionally, when viewed as a commodity, the production of that commodity generated revenue, tax revenue for governments in the form of royalties, secondary use, maybe some domestic supply obligations. And that in a low cost environment and in a high volatility environment and with the demand uncertainty, can you continue to rely upon oil and gas production as a revenue source, or does it play some other role in the marketplace? Do we have to reimagine the utility of this resource in the marketplace? And I think, Chinedu already mentioned this, and it's an important one. Many of the governments that we've been working with, they're very astute. They realize that perhaps the future and the way they define the viability of the resources is not simply in its ability to become a revenue generating source, but its ability to be a full value chain. I think Chinedu mentioned that the midstream, there's the definition that others have mentioned about the need to reimagine even the brain drain, I think that Mark pointed out, that if you're talking about developing a resource to its maximum potential, this is a public resource, a benefit to the public at the end of the day, one has to imagine not just the production, but the refining, the utilization, the transportation, and ultimately, what economic value does it have in the marketplace? So for example, if you think of a unit of gas, not so much as a, as a royalty source, but as a displacement of another energy source in the marketplace, displacing imported fuels, imported diesel, something of that sort, all of a sudden you don't value it simply for its royalty production, you value it for its economic production. And we know here in the US, for example, we have traditionally very low royalties compared to other markets. But we know, and we've actually calculated these numbers, that the injection of low-cost fuel into our marketplace, for example, the gasification of our economy, has resulted in cost savings. It's resulted in a lower cost of energy. It's also resulted in a carbon production and a carbon reduction at the end of the day. I mean, it's almost a direct correlation between the lower price gas in the US and the reduced use of coal and eventually, the carbon reduction that we've had over the years. So I think one of the main points that I like to share with this audience here, and I'd love to have this be a point of conversation, is, do we need to change the conversation? Do we need to redefine value to not just simply on the resource, but on the impact of that resource in the marketplace? And once you do that, and it leads to a second conversation, which is, well, then what role does the government play? Again, myself being a government advisor. And if governments decide to reimagine this hydrocarbon resource as just one input into a longer value chain, then they start to rethink the way they even regulate the resource. For example, rather than chasing upfront revenue in the form of taxation or royalty, you may actually want to decrease the government take at the production level, but increase, for example, a domestic supply obligation, increase potentially, the requirements for integrated projects, that no longer do we want simple investment in production, we want investment in the full value chain of production, onshoring, refining, and delivery, to an actual consumer in the domestic marketplace. And perhaps you even rearrange your tax design to accelerate, say, for example, depreciation on the full, asset chain, on the actual, midstream infrastructure, the downstream infrastructure, and you're no longer just chasing rent. You're no longer just chasing that, that royalty revenue. And if you do that, and we've seen some, some governments, I think, be very successful in that space. For example, the new legislation proposed in Nigeria, Uganda's moved towards this. Senegal, I think, has a very holistic view of how to leverage its gas resources. You are doing two things simultaneously. You're designing the marketplace in a way that captures value and keeps it domestic, in terms of the utilization and the consumption. You're also accommodating the cost reality by reducing the upfront government take. You're reducing overall production costs, and you're making your resource more viable in this low cost environment. So we think of it as a trade-off, that you can provide the production side, the upstream side of the industry, with the cost savings they need to remain viable, but demand some other extraction of value elsewhere in the value chain. And that if you approach it in that holistic way, I think that's both viable, it's productive, and probably it takes advantage of the last point that I'll make. The most valuable asset that Africa has, especially sub-Saharan Africa, is demand. It has the fastest growing demand growth in the world. It has one of the most improving forms of energy usage in terms of distribution. The fact that you can put LNG in a container and ship it off in the middle of nowhere for a hybrid and LNG solar system. The innovation taking place in energy consumption in the African marketplace creates amazing use cases, amazing opportunities for utility of energy. So I think if you direct that supply, if you direct the consumption domestically, you find that the African marketplace becomes a cutting edge energy consumer. It's imagining entirely new value chains, but it needs that input. And I think orienting oil and gas regulation, orienting thinking at the regulatory level towards capturing downstream value is probably, to answer the question, the future of African oil and gas in my mind.
Lots to discuss, Mohammed Badisi. I'm sure we'll be coming back to some of these points. Thank you for your contribution. Jerome, over to you. What are you seeing? What are you thinking?
Thank you. I think we're really in the middle of a very interesting shift in the debate, as Mohammed pointed it. Indeed, when Mark about very rightly about the problems of getting some debt finance and equity finance, we're talking here more the upstream than the rest of the value chain. And indeed, apart from a Salah which benefits from the financial support of one of the largest PE fund in the world that has that strategy. Dave Rubenstein always said that he wanted to invest abroad, and Carlyle does. Just, I think, acquired the assets of Occidental in Colombia, so they're going on, doing a lot of things like that. Whereas even KKR retrenched from the Eastern Hemisphere, and let alone other funds which were too focused on the US asset base and took the hit of the oil price and the crisis around the COVID and demand. So PEES is becoming very difficult to access, and obviously debt also, not only for RBLs, but every kind of debt, except, as rightly pointed by Chinedu and Mohammed, perhaps for local and regional projects. And when I say local, it's because there is a pot of liquidity in Africa, which is looking for a place to invest. And Mohammed mentioned Senegal, and we have a company producing gas, believe it or not, in Senegal. It's not BP, it's not the other guys, it's just a small company, and there is a huge demand there, and it is accessible. And when we speak to local investors, I mean, there's a bunch of liquidity in West Africa, a bunch of liquidity in South Africa, a bunch of liquidity in Nigeria, obviously, that, sometimes flies to the low-hanging fruit, or apparently low-hanging fruit, and it can give some, I would say, mixed results, like with 7 Energy. But in other cases, it's very interesting to try and link the local financing capacity of those markets to their main resource, which is, as rightly said by Mohammed, demand, and demand infrastructure. Now, you have other people looking around, and you have even a competition to that type of financing, which I would call a virtuous financing. One obstacle may be the international aid programs, because some of the countries have been used to going around and asking for donors, and donors to give, oh, I got 2 billion, I got 3, you're not as good as I am, and so on and so forth. And the donor type of philosophy doesn't really command economic growth. It is a different. It doesn't trigger competition. It doesn't trigger economies of scale, and so on and so forth. The second obstacle, and it's a pity, is that some of the international financial institutions, especially those from America or Europe, and perhaps less so from Africa, if they were not to follow the example of the other ones, are cumbersome to mobilize and expensive and long. You need to tick all the right boxes to be able to access some of this capital, which is available, but sometimes with criteria which are designed elsewhere and that don't work as well as they should to be able to respond to the local, and to trying to support locals and local companies. So I guess the solution may be indeed to be able to bring value of the whole of the value chain to the countries by trading off the immediate, apparently immediate benefit of tax revenues from production, which is exported, to the more constant and long-term benefit of having an economy that is the growth of which is supported by the availability of energy. When you see, for instance, that recently Sudan has decided to stop, exporting crude, importing refined products, and has a project to do 4 refineries. Why 4? Don't ask me. But 1 would be already good. Like in Nigeria, having finally those refineries working would completely change the picture. So those countries who say, okay, enough with exporting our value add, and try to repatriate it by building the proper infrastructure, proper environment to be able to do that. I'm afraid Nigeria has not completely solved the Rubik's Cube of the gas bill, but it's progress which is done on those countries, which will change the way Africa can grow its economy. So shifting from the export-oriented projects to more domestic projects with local actors, able also to take the energy from Asala or in Ivory Coast from the production as Foxtrot or whatever, to import it on the domestic demand market, and will trigger the opportunity to finance those developments also locally and regionally, not only from the international markets.
Thanks, Jerome. There's lots of things you can say. I can see that you've got it short, so thank you. And we'll come on to some of these points in the Q&A. Mohammed Stevens, last but certainly not the least, tell us what you're seeing and what you're doing.
Hi, good morning, good afternoon, depending on where you are. Mohammed Stevens. Just like Mohammed DC, I work mainly with governments, providing governments with support on how to maximize their oil and gas resources. Well, I think, with regards to the question of what next for Africa's oil and gas, I think, there's a short-term perspective and more of a long-term perspective. The short-term perspective would be taking into consideration COVID and how it would impact the world in the next year, say 2021 towards 2022, depending on whether there's a vaccine. If there is a vaccine, and I guess there's a halt to the virus, the markets could recover quite a lot, particularly the oil and gas market. I think towards the medium to long term, we have to look at it from a broader perspective. There's the talk of peak demand, whether we've actually reached peak demand or whether we're close to reaching peak demand. At 100 million barrels, around about 100 million barrels of oil production a day. Some people are arguing, we'll reach peak demand. Some are arguing that you might take up to 110 million barrels of oil. But what certainly becomes clear is we're pretty much reached plateau. It would either flatten out, and there's an expectation mid 2020s to mid 2030s that demand will start falling. And obviously when demand was on a trajectory going up, there was an opportunity for high cost producers to get involved in the market. With demand pretty much flattening out or almost at plateau, it would mean that some of the low oil cost producers, some of them are involved in OPEC, they have been to a certain extent artificially keeping the oil prices at a particular level. Would not be willing to do, would not be as willing to do that, because then there will be more now of a need to solidify your access to the market, and which would definitely mean that a number of high cost producers would come offline. This could impact a number of African countries. The number of African countries are producing in comparison to the ones that aren't, are very small. So quite a lot of African countries are still in the position of doing exploration work. And, with oil prices, where they are, it's very unlikely they would ever reach those high prices again. A number of people are arguing, if you're able to get late 50s, that's as high as oil prices would go. So there's a lot of exploration projects that would not come on stream, especially when you think of the deep offshore. There's a number of African countries that, where they have prospects, where, the geology is the most favorable, is quite deep offshore, which, current oil prices, it means the chances of, actually, getting a company to do exploration work is, quite slim. So it'd be more countries with, near onshore and onshore exploration that, would be able to, be in the market for the meager resources for exploration. Obviously, a number of companies have cut back on the exploration budget. So, things would be quite challenging. And obviously, you have the whole renewable energy drive, the whole push because of the Paris Agreement to cut down global emissions. That has seen a lot of, debt finance going into the renewable sector. And, as with every technology, the more research and development that goes into a particular sector, the more prices come down. In the early, 2000s, it was quite hard. Prices for solar PV were quite expensive, but obviously with such huge investments going, prices are coming down, including wind and and hydropower. When you look at the renewable sector, you look at solar PV. solar PV at the moment only captures about 19 to 20% of the solar that's dispersed. And there's more, more research and development is being put in place to increase that amount to say 30%. And when you look at the cost, the levelized cost of electricity and solar and wind, it's already competitive to gas projects and with competitive to gas to coal projects. So obviously, in the coming years, with more investment and more money being put in, renewable would obviously become a lot more, competitive. In some cases, even cheaper than coal and gas. So we really have to take that into consideration. Obviously, the issue with renewable is the intermittency. There's quite a lot of technology being put into batteries, but obviously that's still not foolproof, and there's a requirement of huge investment for solar batteries, and which would have an impact on minerals, because depending on the availability of minerals for the production of solar batteries. So I think African governments really must look at where they are in the resource life cycle and try to make a decision based on that, base policies on that, because access to markets is getting slimmer and slimmer. And lastly, I'd just like to say countries should try and focus on a regional trade, like say for instance, African continental free trade will open up a lot of markets for African countries, not necessarily having to rely on global markets. Thank you very much.
Thank you, Mohammed Stevens. Lots of really interesting points around the dynamics locally in Africa and what we can do to power the continent itself. Thank you to all the panelists for your individual opening remarks. Now we're going to move on to Q&A. And again, in a fairly conversational to start the discussion, Mark, maybe if I can come back to you. You raised a couple of really interesting points for me. One was around if you don't finance, if there's no financing available, there'll be no wells, and there'll be a decline in production eventually. The question that a lot of people debate is, and actually Mohammed Stevens talked about, is what is the peak demand, and how do you respond to something like that as a company when financing, in terms of financing and in terms of the outlook? Any thoughts?
Yeah, okay, thanks. Well, certainly access to capital is, as I said, important to reinvest. Many of the African oil and gas assets are mature. So in West Africa, a lot of the oil fields are pretty mature. So they do require a steady reinvestment, not to the level of the North American shales, but a steady reinvestment to maintain some kind of plateau. So I think as businesses, as oil companies, we're frankly price takers in the market. We can't control the price. We just need to react to it. So every year there's a rigorous budget cycle when we look at the forward curve. Hedging is obviously a very important part of that mechanism to secure revenues against the near-term investments. So I think a lot of scrutiny on the investments that we select is important to high grade the best ones, with emphasis on things like the speed of payback, as well as the geological risk or the technical risk associated with the investments that we select. The ability, I think another important one is the ability to stop as well as to start. So if we see a sudden drop in the oil price, for example, as we did this year, so a very dramatic short-term drop in oil price, we were able to stop our drilling without incurring any penalties with our drilling contractor, the way we had structured the contracts. So we can terminate drilling quite quickly and safely, and yet have the ability to resume drilling when production starts again. And I think that's one of the panelists mentioned that some of the the onshore near infrastructure oil fields, I think, lend themselves to that kind of more stop-start mechanism, that reactivity and that agility, compared to this idea of, as Mohammed Stevens pointed out, that the deep water offshore prospects that are very difficult, that have a long mobilization period, and you're really committed from an early stage. So I think those are areas where we can only react to the market as price takers. and make sure that we work closely with our lenders and our investors to ensure that the capital is there. And also, I think for the investors, that their expectation of yield is kept abreast, that they're fully informed of the plans that we have. They're on board with them from the outset. We've got certain mitigation strategies in place in case oil prices go down or up. And then we really execute to the plan. So I think that's really the best way to do it, and hence the emphasis on agility and having the ability to react to the market as required.
That's great. Thanks, Mark. Lots of really good pointers for companies. I am going to come back to you with a rejoinder to that, to ask what would your advice be to some of the smaller independents, to private companies with regards to seeking financing in the current environment. But I'm going to invite comments. Before I ask you that question, I'm going to invite comments from any of the other panelists. I can see, Jerome, your hand is very close to the mute button. So do you have any comments on that?
You spotted me, yeah, absolutely. I mean, there's different kinds of investors. Obviously, when you see ExxonMobil, Exxon now, posting a loss for I guess the second or third quarter in a row, and so on. This is one kind of target for investors. But you mentioned earlier that some of the independents were benefiting from the fact that majors were retrenching from some of the geographical areas. But if you look at what Cairn posted recently, or difficulties that Tullow had, or FAR in Senegal and Gambia, you see that life is not that easy for those companies. Those which are listed suffer from a sectoral rotation, and oil and gas, as you rightly mentioned, is not very much the flavor of the day-to-day. And those which are supported by PE, either PE is somewhat stuck and can only try and support their investment thesis of the early days, or you face some investors who are attracted by the quick and dirty, opportunity to flip an asset and flip a position and try to make money out of it. And obviously, these have somewhat disappeared in the recent period where the whole industry was hammered. So as we heard very rightly earlier from Mark, the banks also have to show a green face and considerably retrenching from the oil and gas industry. So I think today the support for smaller companies is each one is quite different. Depends on the profile of the company and the original investors and what they see in the package where they invest. And there's no rule of thumb anymore that there is a market where you can simply go to. You have to find the right people. You have to find the right funds. There's a fund in the South Africa and UK that we like working with, and they said, we're not going to take an investment decision until the second quarter of 2021. So it's because they simply look at what the opportunities are, but also the risk reward, and they don't see the proper mitigation of risk, despite of what Mark says, that the companies today have to adapt to the market. And I guess this triggers a question to Mark, but I know other speakers obviously will want to chime in. But if you show this agility, being able to hop on, hop off, and so on, can you expect returns which are above utility type returns? Can you still expect returns which were delivered by the E&P until the price dropped and some of them took a bloodbath? I think we're changing the profile of the companies, and companies have to show that they care about their investors, and the companies that used to throw dollars out of the window by drilling $80 million wells when they had a market cap of 14, perhaps are not going to be the champions of fundraising coming forward. So each type of company is different, has to show to its investors a risk reward profile which is adapted to what they want to do. And that's very difficult today.
Indeed. Thank you, Jerome. I'm going to come back to you, Mark, to see if you've got any final comments on that before we move on to another topic.
Okay, so I think that the advice for small companies, I think there's a phrase called product market fit that's used in the technology sector, and I think really access to capital, you've got to have the product fit the market. So that means if you've got an investor, somebody pointed out that's unique in South Africa or West Africa or Nigeria, that really knows the market, that has a compelling case, that can demonstrate a good level of liquidity or a good yield, then I think there is always a good match. But just to sort of arbitrarily get a fund from one country and put it into a different country and just sort of say, look, the math works out, I don't think that's necessarily going to work anymore. So this tailoring approach, I think, is definitely a good idea. And in terms of the question about the yield or the profitability of portfolios, I mean, you know, I've worked on portfolios that have low dollars per barrel operating costs, maybe sub 10. I've worked on ones with 25. It really is a case of, you know, how prolific the wells are, what the operating costs are, the logistics and the likes. So, you know, we've heard that some of these higher cost assets will fall by the wayside, and the lowest ones will survive in a competitive market. So those assets that the small teams can do more nimbly with less corporate overhead can definitely have a better chance of surviving. And I think for new opportunities, for any new companies setting up, they need to go in with a small focused management team, highly experienced, sensitive to ESG requirements, proficient in speaking with financiers to really clearly make their case, demonstrate an operational capability with a good track record, and have assets that are robust without too much above ground risk. As long as those elements are there, I think those companies would have a good fighting chance to proceed even in $30 oil price or low gas prices. So yes, and also gas opportunities. If you've got gas near energy demand centers, I think that's also an unlocker. If you can unlock new energy sources to support grids, I think that's also a great opportunity. So all is not lost. I think we've got definitely good opportunities out there.
Thank you, Mark, and to you, Jerome, for your contributions on that point around advice to companies. Mohammed Badisi, Mohammed Stevens, and Chinedu, I heard from you a common pattern in what you were talking about is homegrown solutions and developing something that Africa can use in the context of powering itself and using local capital and finding investment from somebody like you, Chinedu, at the NSAI level. So that's quite a complex but a really good a really good trend that we're talking about, and very interested in hearing your thoughts on the dialogues that you're having with the governments. Perhaps asking a direct question, Mohammed Badisi, Mohammed Stevens, and Chinedu, what kind of conversations are you having with governments with regards to some of these solutions, and what do you think is the biggest challenge, and any advice that you can offer to people listening in? So Mohammed Badisi, if I may start with you.
Oh, thank you. It's an excellent question. It's an important one. If I were to pick one particular challenge, and I would actually define it as a resource that's most lacking, it's regulatory capacity. And this comes from a point of empathy, being a U.S. government employee myself and understanding the challenge of being a public regulator. You know, quite a few of the governments that we work with have already struggled in their regulatory role in terms of being reactive in the marketplace, reacting to everything, you know, from permit applications to production plans. They're oftentimes responding to requests from industry as opposed to being, you know, more proactive in the space. And if we are agreeing here, and I really appreciate the comments of my colleagues, that the future is domestic, the future is holistic, the future is a full value chain, we're now asking these already low resource regulators, these already, you know, burdened regulators, to now not just react to a single project, but imagine a full market redesign. Everything from the permitting of pipelines, distribution systems, you know, price rationalization, both in the distribution of gas or perhaps gas to power and having to rationalize electricity tariffs. So this is a significant burden, a significant new role we're imagining for regulators in the African marketplace. And in doing that, one, it requires, put simply, financial resources. Their budgets will have to be increased, their staff will have to be grown, training will have to increase. But also, I think it takes a bit of a shift in philosophy, and this can be challenging. I mean, you know, we here in the U.S. have learned that you cannot issue a permit. You cannot even have a public, hearing on an oil and gas project without some sort of lawsuit coming out as a result or some sort of protest. We assume lawsuits as a default, not as a rarity in our US system. And again, as a lawyer, keeps us in business, so we don't complain. But that being said, if you approach the conversation about market design and the full value chain with the assumption that you're going to have to satisfy some segment of the public that is interested and concerned, and that there will always be some segment that is opposed, but you anticipate that opposition, the act of public consultation, the act of proposing a full market reform, the act of building consensus or some coalition, in the marketplace around this massive reorganization becomes a little less risky. And if we admit that there is political risk in this type of reform, that governments will eventually face some pushback from landowners who have their rights of way taken for, pipelines or others who feel that, energy prices are rising too rapidly, you mitigate some of that risk by having a holistic process and by building consensus across stakeholders. I'll give you just one very quick example. We find in the US that gasification actually has an interesting coalition behind it of both environmental groups and industry, in the sense that it's a transition away from coal, okay? Electrification tends to have an interesting, support from multiple sectors because it implies a decarbonization. So sometimes if you structure these reforms correctly, you reduce, not eliminate, but you reduce some of that political risk and some of that pain, through a holistic process. And again, a well-resourced regulator.
Thanks, Mohammed. I heard transparency, I heard impact, I heard integrated solutions. Mohammed Stevens, that speaks to some of the things you were saying. How is that different in the conversations that you're currently having? Any advice on challenges that governments are facing?
I think, Mohammed Badisi has raised a number of important points. In terms of our advice and that we're providing to governments, obviously the most governments, have a wish to start, producing oil and gas, or to continue producing oil and gas. So, our advice is dependent on where, the particular country is. The first, aspect we always consider is your resource base. Whether the country actually has resources in place that are commercially viable. I guess, the advice we give is hugely dependent on that. In terms of resource base, that's to a large extent is, it's quite minimal what a particular government can do about resource base. I mean, your resources, if you believe in God, it's a gift from God. It's either you have it or you don't have it. And, so it's quite limited what governments can do, but for those without resources is obviously, try to put in place a legal framework to try to, attract service companies to do, the necessary due diligence for them, acquiring seismic or, different types of seismic, 2D, 3D, etc. So, so it all depends on the, on the particular stage or particular government is. And then, we always have to look at the market. The oil and gas market is global. There isn't any single, country or government that could actually have an impact on its own on the market for oil and gas. So it is important, for, countries to take that into consideration. And in taking that into consideration, they have to look at, the laws and regulation, the fiscal terms in their laws and regulations, try to make it as competitive as possible. The whole aspect of regional cooperation is important for governments not to, enter what is called a race to the bottom, where, you're pretty much just giving out your resources simply because you want investors to come into your, and do exploration work. Because obviously, oil and gas resources are finite by nature. So it is important that, as you, exhaust that resource, you're, getting some other resource in exchange. And then governance, legal risk, terrorism, political, all of, and governance, that the government, an important part of what Mohammed Vadisi mentioned was, in terms of capacity, whether the particular, government agency, whether it's a regulator or oil company, national oil company, actually has the capacity to be able to make the most of, its potential resources.
Great, thank you, Mohammed Stevens. Chinedu, we've kept you quiet for a long time, but you must have been listening with interest as to the plans for international operators like Mark to be growing, Jeroen to be advising them, and the lawyers in the room telling us how governments can work better to find good solutions for local companies and local cooperation across regions. Great point, Mohammed Stevens. So Chinedu, when you hear all of this and you're investing in companies in Africa, what do you think when you hear this, and how does this interplay with your investment criteria and any advice to investors? To people seeking investors?
Okay, thank you, Therese. I think most of the points are clearly valid. From where I sit, we invest in these sectors through private equity managers, right? So we fund the private equity managers who go on and look for this. And from what we see, we're seeing that there has to be a form of a decomposition, I would say, or of where the investments should be. I believe that to a large extent, what has been the bane of some of these projects in moving into new vistas has been the fact that these projects are a bit too large, take a lot of developmental risk, and the ability to actually get returns and even complete them, right? It's enormous. You have to take it over a few decades, for instance. We have projects that have been going on for decades, and what an investor would look out for are those, will I say, small bespoke projects, right? That are low-hanging fruits, able to easily, not necessarily plug and play, but are close enough to infrastructure at this considerable cost that you're able to deploy, execute, and get returns. And that's key. Instead of having one big project, the whole idea is, I would say, bankable projects, which you have similar projects in certain regions, right, in different areas, be it across the country or across the region. One other thing I would like to add to that is we need to start looking at the region as clusters, so to speak, right? I know there's been a lot of agreements we have the Africa trade agreement going on, but however, the national governments, right, needs to actually look at, and investors need to actually look at these markets together instead of as individual, like in Nigeria or something. So that obviously makes this project a lot more scalable. That goes further to de-risk the projects when it comes to political risk or exchange rate risk or whatever. And if we're able to do that, that certainly would make the investment bankable. And finally, I would like to say that something has to be done to definitely increase, to grow the demand, right, in-house, right? Africa, as we know, is certainly not the richest continent, and efforts need to be made by government. And I guess that's what Mohammed Badisi says, how you have to have regulations such that demand is catalyzed. And those are the points I would like to raise at this point.
Thank you, Chinedu. Gentlemen and lady, it's been a really good debate. I think there's lots of really interesting points, and I'll pick on just a very small number just before we go off and we conclude the session. We talked about the small companies needing a proper strategy, and that's not just having a strategy. We talked about execution of the strategy in a way that responds to the current market, current reforms, the governments, as well as the demand side. It is no longer about you having the supply and therefore being able to secure financing and make money. It's about you meeting the demand. So I heard that from the operators and from the advisors. I also heard that profitability is key. And of course, it's key in any environment. But in the current context of attracting capital, it is more and more important in the context of energy transition and how do you compete with the returns that alternative sources of finance. Demonstrating profitability is really critical. I heard then a really new interesting trend from three of the panelists around homegrown solutions around, and that is developing solutions that are bespoke, that are about the empowering the local market. It's about creating a local solution and a local powerhouse, if you like, within countries that can do this in the context of the reforms, as well as the infrastructure and the financing available. But that seems to be one of the newest things that I've heard, and it's great to see such views that not only is international investment and international operatorship welcome in Africa, but also Africa is developing its own solutions. Maybe in next year's discussion, we will be talking about some of these projects and saying, look, what happened in the last 12 months around that. I thank you all for your contributions and for your time. And we look forward to speaking again and seeing you in person, hopefully, very soon. Thank you.